Most people think there are 3 retirement accounts: a 401k, an IRA, and maybe a Roth if they've read one article. There are actually 8 distinct account types available to most Americans. The order you fund them is worth more than your stock picks. And if you've been doing it in the wrong sequence, which statistically you almost certainly have been, the cost is not a rounding error. It can exceed $200,000 in permanently lost compounding over a 30-year career. I'm going to show you all 8 today, give you the exact sequence that matters, and tell you about the one account that gives you a tax deduction and tax-free growth simultaneously, which sounds like it shouldn't be legal, but is completely and explicitly legal. We're doing this fast. Let's go. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the frame I want you to hold for this entire video. Retirement accounts are buckets. The government, in one of its rarer acts of structural charity, lets you fill these buckets with money before it's taxed or after it's been taxed, or sometimes in a way that's never taxed at all. Different buckets, different rules, different trade-offs. And here's the thing about buckets. Once a year passes, some of them disappear. You cannot go back. You cannot retroactively contribute to an account for 2023. That year's bucket is sealed and gone. Leave the bucket empty long enough, and it stays empty forever. That phrase is going to follow you through this entire video, because the real cost of retirement ignorance is not bad investment returns. It's the taxes you pay on money that didn't have to be taxed, and the compounding you forfeited on those taxes, compounded again over 30 years. That's the loss most people never calculate because they don't know it exists. In a few minutes, I'm going to tell you about an account that functions like a retirement account, a medical account, and a tax shelter simultaneously, one that most people with access to it use completely wrong. But first, let me explain why the most popular retirement account in America is also the most misunderstood one, the 401k, named after Section 401, subsection K of the Internal Revenue Code. It was added to the tax code in 1978, and this is important context that almost nobody knows. It was originally designed as a supplement to pensions, not a replacement for them. Congress created it so executives could defer bonuses. That was the intent. Then corporations figured out they could eliminate defined benefit pensions entirely, point employees at the 401k, and transfer all the investment risk from the company to the individual, which is exactly what happened. Pensions didn't fade away. They were deliberately replaced, plan by plan, starting in the early 80s and accelerating through the 90s. You're not using a retirement system built for you. You're using a workaround that got repurposed. Here's the mechanical reality of how it works. You authorize your employer to take a portion of your paycheck before taxes and put it into an investment account. That money grows tax deferred. You don't pay taxes on the gains each year. You pay ordinary income tax when you pull the money out, which can't happen without a 10% penalty before age 59 and a half, with some exceptions. For 2026, the employee contribution limit is $24,500. That's up from $23,500 in 2025. If you're 50 or older, you get an additional $8,000 in catch-up contributions. And here is a new rule most people haven't internalized yet. If you are between ages 60 and 63, specifically not 64, not 59, you qualify for what Secure 2 calls the super catch-up of $11,250 instead of the standard $8,000. This means a 62-year-old can defer $35,750 in employee contributions alone this year. That's more than most Americans earn in a year. The bucket is large. Most people never fill it. Now, the employer match. This is where I need you to stop being polite about it. Your employer offers to match your contributions often 50 cents on every dollar you put in, up to 6% of your salary. If you make $100,000, 6% is $6,000. Your employer adds $3,000 on top. That is a 50% return on day one. Before the market does anything, before you've picked a single fund, The total 401k savings rate for those who contribute is 14.3%, a record high, which highlights a wide gap in retirement readiness between savers and non-savers. Meanwhile, over half of American households, 54%, report having no dedicated retirement savings at all, according to the Federal Reserve Survey of Consumer Finances. We are calculating averages for a group that barely exists. But here's the thing, almost nobody tells you about the employer match. It might not actually be yours yet. Many 401k plans have vesting schedules, meaning the employer's matching contributions belong to the company on paper until you've worked there long enough to vest. A 3-year cliff vesting schedule means you walk away with zero of the employer's money if you leave before year 3. A 6-year graded schedule means you earn ownership of the match incrementally over 6 years. If you leave after 2 years of service at a company with a 3-year cliff, you leave every dollar of their match behind. Check your summary plan description. It's a document your HR department is legally required to give you. And when you do leave a job, pay attention to what happens to your 401k. The single most expensive behavioral mistake in retirement finance, more expensive than a bad stock pick, more expensive than timing the market wrong, is cashing out a 401k when you leave a job. You pay ordinary income tax on the full amount plus a 10% early withdrawal penalty. On a $60,000 401k balance, that can cost $15,000 to $20,000 in a single tax year. The right move is almost always a direct rollover to an IRA at a brokerage of your choice, which is tax-free, penalty-free, and puts you in control of your investment options. Which brings me to the fees. And this is where I need you to stay with me because the math is going to offend you. Inside your 401k, you pick from a menu of investment funds. Each fund charges an annual expense ratio, a percentage of your balance taken automatically before returns are reported to you. When you're comparing fund options in your 401k, you might notice expense ratios ranging from 0.03% for an index fund to 1.25% for an actively managed fund. That is 41 times more expensive. And the actively managed fund almost certainly won't earn that difference back. According to the S&P indices versus active funds scorecard, the majority of active funds underperform their benchmarks over 1, 3, 5, 10, and 15-year intervals. You pay 41 times more to get worse results, on average. Consider a 25-year-old who expects to retire at 65, has $25,000 in retirement savings, and saves $10,000 a year. Paying just 1% in fees could cost that person more than $590,000 over 40 years. Not because of bad investments, in fees. To a fund that statistically trails an index, a 2021 Government Accountability Office study found that almost 40% of 401k participants don't fully understand the fee information in their disclosures. Even more striking, 45% can't use the disclosure to determine their investment fee, and 41% incorrectly believe they don't pay any 401k fees at all. The fees are invisible because they are deducted before the return is reported. Your fund says it returned 7%, it actually returned 8%. 1% was taken before you ever saw the number. Pattern interrupt. You are not being charged. You are being harvested, slowly, invisibly, for decades. There's also a Roth version of the 401k that many people don't realize exists. Many plans now offer a Roth 401k option, where you contribute after-tax dollars, no upfront deduction, but the growth and withdrawals in retirement are tax-free. Same contribution limits. The choice between traditional and Roth 401k is a tax bet. Are you better off paying taxes today at your current rate or later at your retirement rate? I'll give you the framework for that decision in the IRA section because the logic is identical. One more 401k feature that almost nobody uses, the mega backdoor Roth. Some plans allow after-tax contributions beyond the regular employee deferral contributions that, combined with your employer match, you can bring your total contributions up to the full combined limit of $72,000 for 2026. Depending on your plan, you may be able to contribute up to the total employee and employer contribution limit. provided existing contributions do not exceed it. For example, if you're under 50 contributing $24,500 and your employer contributes $20,000, you could contribute up to an additional $27,500 in after-tax contributions to reach $72,000. If your plan then allows in-service distributions or an in-plan Roth conversion, you can move those after-tax dollars into Roth where they grow forever tax-free. It's called the Mega Backdoor Roth. Most plans don't offer it, but if yours does, it is one of the most powerful legal tax maneuvers available to a high earner. Now, in a few minutes, I'm going to introduce you to a man who made a perfectly logical financial decision based on incomplete information, and that decision cost him more than most people spend on a car every single year for 8 years. But first, let me explain the IRA, because this is where the system reveals whether it's actually on your side. The individual retirement account was created in 1974, before the 401k even existed. It solves a simple problem. What do you do when your employer doesn't offer a retirement plan, or the investment options inside your plan are terrible, or you want to contribute more than the plan allows? The IRA is your personal account, not tied to any employer, portable, and completely under your control. The IRA contribution limits for 2026 are $7,500 for those under age 50 and $8,600 for those 50 or older. 2 flavors, traditional and Roth. The mechanical difference is simple. Traditional is pre-tax in, taxable out. Roth is after-tax in, tax-free out. Pay the government now or pay them later. You think the question is which one is better, but actually the real question is better at what, for whom, in what year. And that reframe changes everything. The conventional advice, Roth, if you expect higher taxes in retirement, traditional, if you expect lower, is technically correct and practically useless because nobody knows what tax brackets will look like in 2035. More than half of Americans who haven't retired yet, 52%, say they expect to rely on Social Security benefits to pay their necessary expenses once they exit the workforce. Yet more than 3 in 4 of them are concerned they won't get the full benefits they've been promised. Beneficiaries could face a 23% cut to their payments in about 8 years, according to the program's annual trustees report. Congress will respond to that with some combination of tax changes, benefit cuts, and creative accounting. Predicting exactly what taxes look like in 2033 is not analysis, it's a guess wearing a spreadsheet as a costume. The more useful frame. What's your tax situation this year specifically? If you are in a high income year, top 22% marginal bracket or above, a traditional IRA contribution, if deductible, is saving you real money right now. A $7,500 deduction at a 24% rate is $1,800 back in your pocket this year. That's certain. Retirement tax rates are not. If you're in a low-income year, you change jobs, you're early in your career, you took leave, you had a business with unusual expenses, Roth is almost always the right call. You're paying taxes at a lower rate today and locking in tax-free growth forever. Every dollar in a Roth IRA compounds without the government touching it. Not once, not in 30 years, not in 50 years if you never need to touch it. Here's the Roth IRA income limit for 2026. The income phase-out range for taxpayers making contributions to a Roth IRA is between $153,000 and $168,000 for singles and heads of household. For married couples filing jointly, the income phase-out range is between $242,000 and $252,000. Above those thresholds, direct Roth IRA contributions are phased out entirely. But, and this is where most people stop looking, and shouldn't, there is a legal workaround called the Backdoor Roth. You contribute $7,500 to a non-deductible traditional IRA, then you immediately convert it to a Roth IRA. The conversion is not a new taxable event because you already paid taxes on that money. 2 steps, completely legal, explicitly acknowledged by the IRS. This has been standard operating procedure for high earners for over a decade. The one catch, the pro rata rule. If you have existing pre-tax traditional IRA money anywhere, at any brokerage, the IRS treats all your IRA money as one pool when calculating the taxable portion of your conversion. A $60,000 pre-tax IRA and a $7,500 non-deductible contribution means roughly 11% of your conversion is tax-free and 89% is taxable. The clean solution: roll your pre-tax IRA money into your employer's 401k first if the plan accepts rollovers. Then execute the backdoor Roth. This is 15 minutes with a CPA, and it's worth every dollar you pay them. Now, here's what traditional and Roth IRAs do differently in retirement that almost nobody factors in: required minimum distributions. Traditional IRAs force you to begin withdrawing money at age 73, whether you need the money or not, and pay ordinary income tax on every dollar. The government has been patient long enough. Roth IRAs have no RMDs during your lifetime. Your money keeps compounding on your schedule, not the government's. This is deeply undervalued in retirement planning. There's a phenomenon called the tax torpedo, and it hits people who over-concentrated in pre-tax accounts without planning for the distribution phase. Imagine a retired engineer who spent 30 years maxing his traditional 401k and traditional IRA. He retires with $1.8 million, all pre-tax. His RMDs start at 73. The formula forces him to withdraw roughly $70,000 in year one, more in subsequent years, as the account grows and the divisor shrinks. Those withdrawals are taxed as ordinary income. They push him into a higher bracket, which then triggers higher taxes on his Social Security benefits, which in turn triggers Medicare income-related monthly adjustment amount, surcharges a means-tested fee that Medicare quietly charges higher income retirees. He ends up in a higher effective tax rate retired than he was at the peak of his career. He didn't make a bad investment. He made a bad sequencing decision, compounded over 30 years. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, this next account is the one I want you to actually pay attention to, because it is genuinely weird, genuinely powerful, and genuinely ignored by most of the people who have access to it. The Health Savings Account, the HSA. Most people think it's a medical account. They use it like a debit card for doctor visits. They spend it down every year on copays and prescriptions, and then reset. That is the wrong use of an HSA if you can afford to be wrong about it. Here's the actual tax structure. The HSA contribution limit for 2026 is $4,300 for an individual plan, or $8,550 for a family plan, plus $1,000 in catch-up contributions if you're 55 or older. You must be enrolled in a high-deductible health plan to contribute. Now, here's the part that makes this account different from everything else. Contributions go in pre-tax. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are tax-free. Triple tax advantages. Your HSA contributions can be tax-deductible. You can spend on certain medical expenses tax-free, and any growth is tax-free. No other account in the American tax code does all three simultaneously, not one. Your 401k, pre-tax in, taxable out. Your Roth IRA, after tax in, tax-free out. Your HSA, pre-tax in, tax-free out for medical expenses. And here's the angle that turns this from a medical account into a retirement weapon. After age 65, you can withdraw from your HSA for any reason, not just medical, and you simply pay ordinary income tax on the non-medical portion, which is exactly, precisely, structurally identical to withdrawing from a traditional IRA, except you also had the tax-free medical option the entire time. So the optimal strategy for people with cash flow to execute it is this. You contribute the maximum to your HSA every year. You invest the balance in low-cost index funds inside the account, not money market funds. You pay your current medical expenses out of pocket. You keep every receipt, every explanation of benefits, every pharmacy printout. There is no statute of limitations on HSA reimbursements. A medical receipt from 2020 is still valid in 2045. That means you are converting current medical expenses into future tax-free cash. You're running a shadow retirement account that the tax code sees as a medical fund. Here's what that looks like at scale. $40,000 of out-of-pocket medical expenses over 20 years invested in an HSA at 7% average returns. By retirement, that $40,000 in paid receipts is sitting in an account worth perhaps $80,000, which you can now withdraw completely tax-free to reimburse yourself. You have effectively earned an $80,000 tax-free withdrawal on medical spending that already happened. Pattern interrupt. Most people think the HSA is the least interesting account in the stack. It is almost certainly the most interesting one for anyone with a high deductible health plan. Now, meet Marcus. Marcus is 42 years old. He's a freelance graphic designer who has been self-employed for 8 years. His income averages about $90,000 per year. He owns good equipment, works for good clients, lives below his means. He has been putting his investment money into a regular taxable brokerage account, a completely reasonable decision for someone who was told implicitly or explicitly that retirement accounts are for people with employers. He has been paying taxes every year on every dividend, every realized capital gain, every dollar of interest for 8 years, and every year, because he contributed nothing to a tax-advantaged account, he left his annual contribution bucket completely empty. 8 years. 8 sealed buckets. I'll resolve Marcus's situation shortly. But first, I need to tell you about the accounts he didn't know he had access to, because this is the part of the retirement account system that the personal finance industry systematically undersells to self-employed people. A SEP IRA, Simplified Employee Pension, is a retirement account for anyone who is self-employed, owns a business, or earns freelance income. You can contribute up to 25% of your total compensation or a maximum of $72,000 for the 2026 tax year, whichever is less. Contributions are fully tax deductible. The account works exactly like a traditional IRA on the distribution side. And setup is a single afternoon at any major brokerage. Marcus earns $90,000. 25% of $90,000 is $22,500. He could have been sheltering $22,500 per year from income taxes every year for 8 years. Instead, he paid full income tax on every dollar and invested the after-tax remainder in a taxable account. But here's why the solo 401k is often better than the SEP IRA for a solo operator like Marcus. A solo 401k is a retirement plan specifically designed for the self-employed. You don't need your own business to open one. Many people who have regular jobs can have one if they have some form of self-employed income. The structure is this. The solo 401k has 2 buckets because you are both the employer and the employee. Each bucket has its own rule, and stacking them correctly is the entire point of the account. As the employee, Marcus can defer up to $24,500 this year. As the employer, he can contribute an additional 25% of his net self-employment income, roughly $20,000 on a $90,000 income. Combined, he can put approximately $44,000 into a single solo 401k this year. Total, tax deductible, one account. The SEP IRA, by contrast, only allows the employer side contribution 25% of compensation. At lower income levels, this means the solo 401k almost always wins. At lower income levels, a solo 401k often allows higher total contributions because of the employee deferral of $23,500 regardless of profit level. A SEP IRA is capped at 25% of compensation. You need over $280,000 in net income to maximize the $70,000 SEP limit. SEP IRAs do not allow catch-up contributions at all. This makes it harder for those age 50 and older to save as aggressively as they could with a solo 401k. There is one procedural thing Marcus must remember. The solo 401k employee deferral must be elected by December 31st of the tax year. Miss the December 31st deferral election deadline, and you lose the entire employee bucket for the year. Permanently, The employer contribution side can be made up until the tax filing deadline, including extensions. But the employee bucket, year end, that bucket closes. There's also a new wrinkle for 2026 that every high earner with catch-up access needs to know. Starting in 2026, if you earn more than $150,000, catch-up contributions must be made as Roth after-tax contributions. Previously, you could choose between pre-tax or after-tax. That has changed. If your plan doesn't offer Roth catch-up, you simply cannot make those catch-up contributions until the plan is updated. Check with your HR department or plan administrator. Now, let me tell you about two account types that affect specific groups of people but represent some of the most underused structural advantages in the entire retirement system. The 403B is the functional equivalent of a 401k for employees of public schools, hospitals, nonprofits, and certain tax-exempt organizations. The annual elective deferral limit for 403B plan employee contributions increased to $24,500 in 2026. Same limits, same catch-up provisions. But there's an additional feature that most 403B participants have no idea exists. If you have 15 or more years of service with the same employer and your cumulative contributions in prior years were below a certain threshold, you may be eligible for a special additional catch-up of up to $3,000 per year with a $15,000 lifetime maximum. This is plan-specific confirmed with your administrator, but it's a provision that costs nothing to claim if you qualify. The 457B is the plan available to state and local government employees and to employees of certain nonprofits. And it has a structural feature that makes it uniquely interesting for anyone pursuing an early retirement. If you separate from service, meaning you leave your job, you can access your 457B funds penalty-free at any age. No 10% early withdrawal penalty, zero. Compare that to a 401k, which locks your money behind a 10% penalty wall until age 59 and a half, with only narrow exceptions. A government employee who retires at 52 can access their 457B immediately. Even better, if you have access to both a 457B and a 401k or 403B through the same government employer, the limits are completely separate. You can max both simultaneously. The annual contribution limit for employees who participate in 401k, 403b, governmental 457 plans, and the federal government's thrift savings plan is $24,500 for 2026. Stack a 403b on top of a 457b, and you are sheltering $49,000 per year in employee contributions. Most government employees don't know this is possible. They're sitting on a structural advantage that would make a private sector employee genuinely envious. Now imagine explaining to a public school teacher that she could be deferring $49,000 per year from her combined plan access, and that if she works until 55, she can pull money from one of those accounts penalty-free the same week she retires. Then imagine her face when she realizes she's been contributing only 4% because HR told her that's what most people do. That's not malice. That's institutional indifference. Nobody at HR gets paid to optimize your retirement strategy. They get paid to process your paperwork. Now let me give you a concrete scenario so none of this stays abstract. David is 38 years old, marketing director, annual salary $110,000, single. His employer matches 50 cents on every dollar, up to 6% of his salary. He has access to his employer's 401k plan, an HSA through his high deductible health plan option, and he's eligible for a Roth IRA. His income is below the single filer threshold of $168,000. His current behavior, he contributes 6%, $6,600. He captures the $3,300 employer match. Total in the account, $9,900. He puts nothing else in any other account. He keeps a little money in a savings account earning 3%. Here's what the optimized version looks like. First, he contributes $6,600 to the 401k to capture the full employer match. That's $9,900 total from him and his employer. Non-negotiable. Step 1. Second, he maximizes his HSA, $4,300, all pre-tax. He invests it in the plan's lowest cost index fund option and pays his medical expenses out of pocket when possible, keeping receipts for future reimbursement. Third, he contributes $7,500 to a Roth IRA. At $110,000 of income, he's well under the phase out. He opens one at a brokerage he controls, invests in a total market index fund, and sets up automatic monthly contributions. Fourth, he goes back to his 401k and increases contributions to reach the full $24,500 limit. He's already put in $6,600, so he adds another $17,900. Total tax advantage contributions: $24,500 in the 401k, plus $4,300 in the HSA, plus $7,500 in the Roth IRA. That is $36,300 sheltered per year. With the employer match, $39,600 in total invested capital. His current approach, $9,900, including the match. The difference in invested capital in year one alone is approximately $30,000. $30,000 invested at 7% for 30 years grows to approximately $228,000. That is the cost of underusing available accounts in a single year's difference. Multiplied across a career, the gap becomes a retirement. The magic number Americans think they need to retire comfortably is $1,260,000. Yet the median retirement savings for those aged 55 to 64 is $185,000. And for those aged 65 to 74, it's just $200,000. People aren't falling short because of bad investments. They're falling short because of incomplete use of the available system. Now, Marcus opens a solo 401k this week. He elects a $24,000 employee deferral before December 31st. He still has time. His effective federal tax rate is 22%. So that single decision saves him approximately $5,280 in federal taxes this year. He invests in a total market index fund inside the plan. Setup takes one afternoon at Fidelity or Schwab. Administrative cost, essentially zero. The 8 empty buckets from his prior 8 years, sealed, gone. He will not get those years back. But starting now, he contributes the maximum every year for the next 25 years until he's 67. At 7% average return, his solo 401k alone grows to approximately $1.5 million. Tax deferred. He also opens a Roth IRA this year, $7,500. And given he works from home on a high deductible health plan, he opens an HSA and immediately moves the money into the plan's index fund option. 3 accounts, 3 buckets, all filling simultaneously. The cost of those 8 missed years, rough estimate when you account for compounding on the tax drag alone, is over $200,000 in permanently lost wealth. Not because he made a bad decision, because he had incomplete information. That's not a character flaw. That's a systems problem. And the system doesn't explain itself to you. You have to find the explanation. Leave the bucket empty long enough, and it stays empty forever. But the bucket you open today gets filled starting today. There's a framework I use when people ask me what to do with a limited amount of investable cash per month. I call it the 4-level funding priority, and it looks like this. Level 1, contribute to your workplace plan up to the exact percentage that captures the full employer match, every dollar, no exceptions. Not contributing enough to get the full match is the financial equivalent of declining a salary increase. The math does not get better than an immediate 50 to 100% return. Level 2, maximize your HSA if you have access to one and are enrolled in a qualifying high deductible health plan. $4,300 for individuals, $8,550 for families. Invest the balance. Keep every receipt. Do not use it as a checking account. Level 3, maximize your IRA. Roth if your income is below the phase-out threshold. Backdoor Roth if it's above. Traditional if you're in a peak earning year and value the deduction. $7,500, $8,600 if you're 50 or older. Level 4, Return to your workplace plan and contribute up to the full limit, $24,500 in 2026. You've already contributed enough in level 1 to get the match. Now you're adding the remaining gap. If all 4 of those buckets are full and you still have investable cash, you open a taxable brokerage account and focus on tax-efficient broad index funds. That is not a consolation prize. A taxable brokerage with low turnover index funds is a very effective vehicle. It's just not as efficient as the tax-advantaged buckets. 3 practical takeaways, and I mean specific ones, calibrated specifically to this topic. First, open your 401k plan website this week, not to check your balance, which tells you nothing actionable, but to find your expense ratios. Every fund in your current allocation has 1. If any fund charges more than 0.5% per year, find the lowest cost index fund available in your plan menu, usually labeled as an S&P 500 index, a total stock market index, or a target date fund, and switch your allocation. On a $200,000 portfolio with $10,000 in annual contributions at 7% return, a 0.5% fee costs over $220,000, more than a 0.1% fee over 30 years. That switch takes 4 minutes and costs you nothing. Second, if you have access to an HSA-eligible health plan and you are not maxing your HSA, start treating it as a retirement account, not a medical debit card. Contribute the maximum. Invest it in the lowest fee fund your plan offers. Pay medical expenses out of pocket when your cash flow allows it. Create a folder, digital or physical, where you store every medical receipt you pay out of pocket from this day forward. In 20 years, that folder is a tax-free withdrawal waiting to happen. Third, if you are self-employed and you have no retirement plan, not a solo 401k, not a SEP IRA, not a simple IRA, you are choosing to pay full income taxes on money that could be legally sheltered right now. Open a solo 401k before December 31st of this year. The employee deferral election must be made by year end. Missing it permanently closes that year's employee bucket. The employer contribution portion can wait until your filing deadline, but the employee bucket closes December 31st. Don't miss it. The entire retirement account system is not complicated. It is deliberately fragmented, structured in a way that requires effort to understand, and that fragmentation serves financial institutions more than it serves you. Confuse people by expensive products from people who appear to have answers. Inform people by index funds and maximize buckets. Lazy investing built more fortune than crypto memes. And the most important financial decision you will make this year is not which stock to buy. It's which bucket to fill